Hello. In this video, we'll continue with considering the Section 162 General Business Deduction. Now recall that in order for a general business deduction to be allowable under the Internal Revenue Code, there must be 7 criteria met. First, the outflow must be ordinary, then necessary, and it must be an expense and not a capital expenditure, paid or incurred during the taxable year, in carrying on any trade or business, and there must be substantiation. All 7 must be met. If one of those 7 is not met, you have to consider whether it's an investment activity or personal activity and the specific rules with respect to those. So now we're considering the third criteria, whether it's an expense. Is the outflow considered an expense or a capital expenditure? If it's an expense, then it's going to be allowed as a deduction under Section 162A in the current year. However, if it's a capital expenditure, which means that it's capitalized just like an asset with respect to financial accounting, then under Section 263, it will be capitalized and it will be deducted potentially in future years. So the idea here is that if you're a business and you purchase an asset that must be capitalized, that's going to provide benefit for multiple years, you're going to deduct it, usually through deductions or amortization. Deduct, amortize. Remember, deduct is for tangible assets. Amortize is for intangible assets. So that's the idea. So it must be a current deduction. It must be it must deal with the current year. The current year is the key language. The current year. That's what really is differentiating expense. So the way that we do this, considering an expense over a capital expenditure, is we have to consider an ordering of what's going on. So first, let's ask, is the item being purchased, is it new? Is it a new item? Meaning, has the item where the outflow is related been already existing asset or item? Or is it a new item? Is it a completely new item? If it's a new item or new asset, then we consider, does it benefit more than 1 year? Does it benefit more than the current tax year? I said more than 1 year, but I really mean more than the current tax year with respect to the current tax year and tax return. If it goes beyond the current tax year, then under Section 263, we capitalize and we deduct it as it's going to be depreciated, amortized, or it might be like land and might not even be able to be deducted. But if it only benefits the current tax year, then it's going to be considered an expense. That's with respect to new items. What if it's a used item? Actually, let me take that back. Not used, but what if it's a pre-existing asset or a pre-existing item that that's already present and there's some type of outflow related to it? So let's separate this analysis. So if there's a pre-existing item, well, we have the same rule. If it benefits just the current year, so if the outflow only benefits the current tax year, we deduct it as an expense in the current year. So it's treated as an expense. But what if it benefits more than 1 year? So we're going to talk about various examples of this. So more than the current tax year. I keep saying more than the current or more than 1 year, but really think about it like if you're a calendar year, December 31st, January 1st to December 31st taxpayer, and you have this business expense that you're putting into place in October, it can only benefit October, November, December because you're reporting that year. Next year, it's going to benefit year 2 when it goes beyond that. So if it's more than the current year, then we have to do an analysis. We have to do some analysis. And it's not so straightforward. This is where things get a little tricky. The the case law is, there's a case called Indopco, which deals with some Section 263 concepts, the capitalization concepts. It's not a pure issue. This isn't exactly what the issue is, but this is a Supreme Court case. It's very recent, in the 1990s. And really, there's other cases out there, not just in Indopco. There's Midland Packing, all sorts of cases. But really, there's four common. There's lots of different themes with respect to one versus the other. But there's four I want to mention to you. So the first is repair versus replacement. Now, repair is generally thought of, just like in financial accounting, just to get the asset in its current condition, or get it back into its the original condition. Versus the replacement refers to a substitution of a primary component of the property. Now, if the value of the item is large, so let's say you have a building and you're replacing the roof, that's a large amount, that is going to be a replacement. Now, repair, I'm going to put the first item as the expense. So the first item will be the expense. So the first, in this list of four things, the first is the expense, and the second item that I put in the verses will be the capitalized item. The capital expenditure. So repair just gets it into the condition it already was in. Replacement, you're completely overhauled. Maybe it's a truck and you're putting in a new transmission or engine. So if it's a replacement, it's going to be a capital expenditure, and again, value does have might be considered, and repair is an expense. The second one, and these are all independent. So you can analyze the issue with each independent of the four situations. These are just four common ones. These aren't all the ones out there. Next is maintenance versus improvement or alteration. So an improvement or alteration is thought of as getting an asset, making it, adding use to it, providing a different use. So the idea here is, let's say you have a truck, and before this outflow, it was a moving truck, and you had a manual door on the back and a manual lift where you lifted items up onto the actual truck. Well, what if you had an outflow for an automated lift that went to the ground and lifted the item up to the top, so it helped with obviously lifting stuff up? That would be an improvement or alteration, and that is capitalized. Maintenance, again, just like repair, is just keeping it in its normal condition, its normal everyday condition. Next, arresting deterioration versus prolonging life. So prolonging life is providing extra years, and that's going to go integrally into the asset. It's almost like, it's like a replacement in the sense that's like so integral to the item that it's going to make it last longer. So again, perfect example with the truck is the new transmission. And there's lots of case law, by the way, about big rigs and replacing engines and transmissions and whatnot, and how it looks like, what the rules are. There's special rules out there for that industry. Arresting deterioration, again, just keeps it in the existing condition it was in. It's not adding life or whatnot. And finally, the last one is maintaining value versus increasing value. Maintaining value versus increasing value. And again, you can analyze a specific outflow in any of these four, but these are the four common analysis. So we've already kind of talked about maintaining value versus increasing. You'll notice that these four, repair, maintenance, arresting deterioration, and maintaining value, have some common theme, as well as replacement, improvement, alteration, prolonging life, and increasing life. Increasing value. That should be value there. I apologize. Take that off. Increasing value. I know it's hard to get tripped, or you get tripped up sometimes, the life value, because it's prolonging, increasing, right? Same idea. So that's really the four major types. So you really do your analysis from that point on, and then that deals with pre-existing assets. So it's a new asset versus a pre-existing asset. And I've given you some general examples, but really that's the analysis. Now, it shows you really how slippery this is. And again, it really does come down to a fact analysis a lot of times. There's actually many provisions throughout the Internal Revenue Code where Congress has stepped in and said, okay, well, this generally seems like it should be an expense, but actually we're going to capitalize. Or the opposite, where Congress says this should be capitalized, it economically seems like it should be capitalized, we're going to actually expense it. So some examples of capital expenditures that taxpayers may elect include research and development projects, so R&D, but actually even more broad for tax. That's a good one, a good example. An example of a deductible expense that taxpayers must capitalize includes capitalization and inclusion of inventory costs. Certain inventory costs, which we learn in accounting, that's very broad. Pretty much whatever you pay goes into inventory costs, and some things can be deducted, actually taken with respect to those items, actually have to be capitalized. So that's one example of something that sometimes might be deducted, but actually Congress said, no, you have to capitalize that. So that really concludes our discussion of expense versus capital expenditure.